It's time for the big picture, so let's welcome in the team from Charles Schwab. We've got Collin Martin, Head of Fixed Income Research and Strategy, Schwab's Head of Financial Research, and Mike Townsend, Managing Director, Legislative and Regulatory Affairs at Charles Schwab. All right, I do want to start with you, Collin, because obviously we've got this CPI print behaving itself. We've seen a move on the 10-year. Talk us through your thoughts this morning.
Yeah, it was certainly a good report, pretty much on the year-over-year basis. A lot of improvement on core inflation. That's something that we look at, something that Fed officials look at, and at just a 2.5% increase on a 12-month basis is its lowest reading of this cycle. So certainly good news. Not to be too much of a Debbie Downer, but there were things under the surface that are less encouraging if we are looking ahead at what the inflation trajectory might be going forward. And on a monthly basis, core came in a little bit hot, and we've seen the last 2 months pick up a little bit relative to the months leading up to that. So when we look at that 12-month basis, some of that can relate to what we saw a year ago. And if we look at that short-term trend, we are seeing still some inflationary pressures there. But good news, generally speaking, clearly the bond market likes it. The 2-year yields are down. 10-year yields are down. The 10-year dropped to 4.06%, its lowest reading since early December. This doesn't really change our outlook for near-term changes in Fed policy. I think we'll need to see more readings like this to get some of the hawkish members on board to be more comfortable with rate cuts. We still expect rate cuts sometime beginning this summer and maybe later this year. But our view for the next few meetings, we think the Fed will continue to remain on hold.
Mike, I just want to get your thoughts on that. I mean, where does this leave the Fed? Obviously, we've got through a couple of hurdles this week with respect to obviously a stronger jobs report, which was delayed as well, and now a little bit more of a tame CPI print, although, as Collin pointed out, perhaps a few question marks under the surface. But, I mean, given what we heard from some of these Fed members this week, I believe it was Hammock who said we should be sitting on our hands at least for now. Where do you think this leaves that calculus?
Yeah, hi Sam, it's great to be with you. I do think that the reports this week, both the jobs and the CPI report, probably have us in a hold mode going forward here. Probably, I agree with Collin, probably into the summer. We're going to get another round of reports before the March meeting. That's mid-March, so you're going to get both these data points. And unless you see a big change, I don't see much chance of a movement by the Fed. It's going to be interesting to see how that sort of plays into the dynamics as we head towards confirmation hearings for Kevin Warsh, the president's nominee. We all know that the president wants to see rates lower, so I expect that's going to be a huge part of the confirmation hearing discussion. We still don't know when that confirmation hearing is going to take place, but I wouldn't be surprised if it got going sometime next month in March. And we've got a little bit of time because Powell's term doesn't end until mid-May. So I don't expect any big changes till after Powell is moved on from chair and Warsh is confirmed. So I agree, we're looking at probably summer.
Okay, so at least the takeaway seems to be that the prints we got this week have helped the Fed stay on hold for now, at least. Collin, just as far as some of the next catalysts, I mean, it just feels like, I know you say we've been in this sort of 2026 low this morning as far as the 10-year is concerned, but I mean, what's going to be the next catalyst? I mean, it feels like prior to this morning, we had been sort of stuck in that sort of range. So what are you going to be watching out for on the horizon?
Yeah, a lot of it's going to come down to the actual economic growth data, the consumer, what spending looks like, especially as we approach tax refund season, to see what that does to near-term spending habits. Coming into this year, we thought that there were risks really for the Fed to stay, or to the 10-year Treasury yield to stay elevated, even as the Fed is expected to cut rates. And we saw the 10-year holding in a tight range and then even get out of its recent range lately, just to come back down closer to 4%. We don't really think this trend is going to continue. To see the 10-year yield move meaningfully lower, say below 4%, maybe to get down to that 3.75% area, I think we'd really need to see a slowdown in growth, maybe a recession, and that's not our base case. On the flip side, inflation's still a little bit high. We have a lot of budget concerns out there. We need to keep issuing a lot of debt. meaning we need to find more buyers to finance our spending. So supply and demand dynamics might continue to weigh on long-term yields. And we've seen a rising tide of global bond yields, specifically with Japan. And if global bond investors start to see more attractive opportunities in home markets or either just markets outside of the US, we think all of those factors should keep yields elevated. So to see that meaningful move lower, I think we need to see much slower growth. But again, that's not our outlook.
We're going to have to leave it there. Thanks so much, guys, for joining me this morning, and have a great long weekend.